Hi everyone, welcome back to Celestial Divine. This one is on your IRA data entries and your Roth IRA entries. So, if you want to do some tax mitigation and maybe some estate prep, and you want to allocate entire accounts to particular individuals in the next generation, that can be a great way to add value for a client, particularly if the different children have different career paths or expected income levels, especially when we're looking at the marginal tax rate. So if you're used to doing tax planning, the marginal tax rate is pretty familiar with you. It is the taxable portion on the next dollar of earned income. So say I were to earn another $100 in ordinary income and I'm paying a 35% tax on that because I've already made a substantial amount, then that would be my tax rate, the 35%. Now, you're going to want to consider that when you're taking a look at someone's IRA or Roth IRA. If you know that family or if your client knows their kids well enough to make some simple assumptions on their behalf, you can do those simulations here and create some value for them overall. So the best way to do that is as you're looking at an IRA, if you've added it under an other asset or something that can be divided, you're going to have a balance figure here, and the person is able to make their adjust their bid, correct? For this one, I've discounted it by 22%. That is maybe a reflection of someone being in the 22% marginal tax bracket and expecting to be able to use this IRA and withdraw it shortly thereof. Or maybe this is someone in the 24% tax bracket who expects to be able to invest it for a couple of years tax deferred before withdrawing it. We'll take a quick look at why I have drummed up as a good reference point. And eventually our defaults are going to reflect a baseline kind of intuition of, hey, your IRA should be discounted because your tax bracket is about this high. And if you expect it to go higher in the future, then maybe we need to discount it substantially. Or maybe if it's expected to go lower in the future from semi-retirement or something of that nature, then you could actually lower what that marginal tax bracket is, as you may have that 10-year opportunity to distribute out of an inherited IRA. The other thing to keep in mind is the Roth IRA is going to be the exact opposite, right? As opposed to a brokerage account or a bank account where if you have a step up in cost basis or it's just cash, you probably aren't going to put a premium or a discount on cash unless you do have a particular preference, maybe 1% here or 1% discount there. The Roth IRA most likely should have a premium on it. I think this visual is the best for understanding the Roth IRA premiums. This is a chart that I've put together. It simply takes an expected rate of return, say 8% here in the middle, and compounds both a taxable account and a Roth IRA by 8%. At the end of it, however, that taxable account is liquidated and we're assuming zero turnover. It's just as good as it can get. And we're going to tax at either 15%, 20, or 23.8, just representing the 20 plus the net. And that can tell you what the break even is for expected rate of return and a 10-year hold period, which there's a liquidation. So these are best case scenarios for some of the taxable accounts. So I would certainly argue that 12% premium on a Roth IRA is very reasonable, falls within a reasonable range right here. And if you were to do better, it could be worth up to 16%, or in some of those people, in some cases where people are doing very well both on their investments and their tax bracket is very high, could be as valuable as 22% more than cash if you were to do the identical investments within that account. Conversely, though, if you're just going to take it out in 1 year and it's going to be in something that's only earning 1%, it could only deserve a premium of 1%. The next idea there is that This is the tax deferral benefit in a best case scenario. Most IRAs are going to have RMDs or some sort of distribution on them, so they may not accumulate quite this high. And additionally, you're going to start at that discount because of the taxes owed. You would want to model this out in Money Guide Pro or eMoney, whatever happens to be your financial planning soup du jour. So, yeah, enjoy that and input it on your client's behalf. Otherwise, we're going to have some pretty basic modeling where we're saying a Roth IRA might be worth 5% more and a IRA might be a 17% discount or something of that nature, just to allude to people that you should be considering this and taking a better look. Once you've entered that data on their behalf, or at least educated your client as to why that would be beneficial as opposed to just cash, you are just going to enter the bids here and set it off on its way like you regularly do. We'll take a quick look at the state prep just so that we have an idea of what everyone's bids were across the board and can give you an idea of what those educated bid amounts might look like on a results page for the executor or professional. So here we're on the executor page or professional viewpoint, and you can see an IRA is 100% allocated to this beneficiary number two. It's got a $2 million balance. We went ahead and said that's probably a mistake there at 60% off. It's supposed to be 40% off. And the beneficiary can place their own bids. So here we can see a pretty aggressive discount at 1.56. However, beneficiary one has effectively placed a 35% discount across the whole board. So they must be in a very healthy marginal tax bracket indeed. And then the final person who it was assigned to is simply placing that 24% discount on this, which happened to be the best value. And so the IRA was allotted to them in full. If you're using this for estate prep, you are going to want to take a look at that percentage allocated and then make that IRA beneficiary 100% to beneficiary number two in this case. And then if we take a look at the Roth, it could be the other way, where we have a balance of 1 million and you're going to see premiums from each one of the bids. This person's putting a 2% premium. This person's also doing a 2% premium. And the third is placing a 15% premium, much more aggressive in terms of trying to get that Roth assigned to them. And my recollection of this estate is that they're biopharmaceutical doctor, so they're doing very well and they do not want to be taxed on their retirement accounts assigned to them. Hope that all makes sense. When you do this, you are effectively measuring the next generation's marginal tax brackets and recommending that whole accounts be assigned to individuals with offsetting assets being assigned to other individuals to round out the estate. I would recommend that you update something like this at least once a year, if not sooner. The more diverse, if you have different assets in the Roth than the traditional IRA, you're going to want to do it more frequently. If they are more risky assets in general, you're going to want to do it more frequently. Ideally, if you're more towards that end of life and hospice, maybe you have identical portfolios in each one of those, and you're just kind of getting it set up as needed. That is how you would do that, and it does bring about a real good reason for speaking with someone on an annual basis at least, and doing a refresher on that amended living trust and just making sure that we're assigning the right assets and the right amounts to each one of those beneficiaries. I hope that all makes sense, and I hope you have a great day. Bye.